Hello everyone, a very good evening. Welcome to Oliveboard. This is the JAIIB Foundation May 2025 series for the RBWM paper, and we are covering all the units module wise from this paper, and today we have the unit 29 from module E, which is mortgage advice. So we are studying the additional reading material on home loans. We have studied the different types of mortgage. Now, how can we calculate the various rates when deciding on mortgage or not? Or mortgage advice profession if we are talking about. So in India, the mortgage advice profession is carried out without any regulations. There is no entry barrier and no code of conduct or ethics that are stipulated by any regulation. So any person can enter the profession and provide advice and do business, right? Now if we talk about how can then we decide from where should we take the advice or which advice would be correct in terms of mortgage or not, what is the role of the mortgage broker, all of these things become important. Okay, so one such important thing is the home information pack, which contains the important information that the buyers and sellers need to know, and it has been implemented in UK under the home information packs, which includes the energy information certificates, which is implemented on a phased basis from 1st August 2007 in UK. And from then on, the packs will be required for the sale of four-bedroom properties, smaller properties, and so on. So basically, this idea is something which can be used by the Indian brokers as well as to give a more clearer idea. But now, when we are talking about this particular unit, we will focus on the different uh, numericals that can be asked or certain formulas that can be important in terms of mortgage. So, first we have the time value of money, interest, and annuity. What is meant by the time value? A rupee today is worth more than a rupee tomorrow. A rupee today is worth more than a rupee tomorrow. This means that we need a realistic appraisal for the cash payment or receipt, and it must be related to the time when the payment takes place. In particular, it must be recognized that rupee 1 which is received today is must worth more than rupee 1 which is receivable at some future date. So to illustrate this, if let's say rupees 100 was invested today at 5% per annum compound interest, it would accumulate to rupees 105 at the end of 1 year, then 110.25 at the end of 2 years, and so on. In other words, we can say that 110.25 receivable in 2 years' time is worth only 100 rupees today if 5% per annum can be earned in the meantime. So, this is the whole concept of value of time value of money. So how can we convert the future sums into their present equivalents? This is known as discounting. Discounting, the discounted value or discounting, which is simply the opposite of compounding. Compounding, we are finding out the interest for the future or the value for the future. If we want to convert the future sums into their present equivalents, then we can do so by compounding. So present to the future, compounding, and future to the present, discounting. All right. So frequently compounding of interest. What if the interest is paid more frequently? Then what we can do, we can simply use the formula annually P multiplied by 1 plus R, or we can say annual compounding. This is the annual compounding. For quarterly, it is known as quarterly compounding, and monthly, it is known as monthly compounding. So the final principal after T is equal to 1 year on an account initially with the principal 10,000 at 6%. So we are saying that the principal is 10,000 and a 6% interest rate is there, compounding interest. So if we go on compounding for the years, yearly, semi annually, quarterly, monthly and weekly, these will be our results. We can simply calculate the compound interest, and yearly, semi annually, quarterly, we can do so. Right? So this is the time value of money. Under this, we have three important rules: the rule of 72, rule of 115, and rule of 144. These are the three important rules that determine the number of years before your money becomes almost double, triple, and four times of the principal, whether in debt or in investment. All right. For illustration, let's say we borrowed a sum of 1000 rupees at 6% interest. We will just write it down, a sum of rupees 1000, and the interest rate is 6%. Right? Now, if we divide, let's say 72, if we are following the rule 72, so we will divide 72 by 6, 72 divided by 6, which will give us 12. So it makes 12 the number of years it would take for your debt to double to 2000 rupees. Right? This is how it is done. If let's say there's a savings account with 500 rupees deposited and the interest rate is 4%, interest rate is 4%, then we are going to divide 72 by 4, which will give us 18, and 18 is the number of years which will take 500 rupees to almost double. Similarly, if we divide, let's say, any other number we can take. If we take the rule of, now we'll take the example of 115, the rule of 115. Similarly, we can divide 115 by 4, which will give us the years, 28 years and 9 months. But this will now show us the time that will take our amount of 500 to triple, right? To triple. And if we use the rule 144, then it is going to show us how much time will it take for the initial principal to become almost 4 times. Almost 4 times. So simply we are using the rule 72 to see in how many years our amount will double. We are using a rule 115 to see in how many years it will triple, and 144 to see in how many years it will become 4 times. Simply we will divide the number, the rule, by the given interest rate, and we can easily calculate the number of years. All right. Then let's say we want to calculate the future value of money. The future value of money. So the formula which is used is future value is equal to present value multiplied by 1 plus r raised to power n, where r is the rate of interest and n means the period of term. For example, if rupees 1 lakh is invested for a period of 5 years, so the present value is rupees 1 lakh. The rate of interest is at 10%, and the period or n is 5 years. So how can we calculate the maturity sum? We will simply put these values in the formula. So the FV is equal to 1 lakh, multiply it by 1 plus our interest rate. If we convert into the decimal point, it is 10%, so 0.10 raised to power 5, and it will give us the value. Right? So this is how we calculate the future value of money. And the same value can also be calculated by using the future value table. The future value here will be the present value multiplied by the future value factor, which is the future value factor of rupee 1 at different rate of interest. The table can be given us Like what is the value of rupee 1 at 7%, 8%, 9%, and simply using the calculator we can calculate the future value. All right. So you can take many examples to calculate, simply seeing the table, which makes our calculations even easier. All right. So this we have seen the calculating of the future value. Now, what about the future value of the annuity? So the calculating the future value of an ordinary annuity. Annuity is something, let's say you purchase a pension plan or an insurance plan on which annuity is paid to you for a certain time period. That is annuity. So if you know how much you can invest per period for a certain time period, the future value of the ordinary annuity formula is useful for finding out how much you would make in future by investing at your given interest rate. So if you are making payments on a loan, the future value is useful for determining the total cost of the loan. And how can we calculate the future value in case of annuity? So this is the formula. This is the formula for calculating the future value of ordinary annuity, where F is the future value of the annuity, A is the annuity, I is the interest rate, and N again is the term. N is the term, right? And similarly, we can also calculate the future value of annuity on an annuity date, on an annuity date. In this formula, which is given for the ordinary annuity, we will simply multiply it by 1 plus r. So this will give us the calculating of future value on an of an annuity date. For example, let's say we take the same example that we had taken earlier, the value, the future value of annuity due of rupees 1000. We need to calculate the amount due, which is rupees 1000 for a period of n, let's say 5 years, and the rate of interest would be 5%. So if we put all of these values in the formula which is given, so 1000 multiplied by 1 plus it is 5, so we will take the decimal 0.05 raised to power 5, which is the number of years, minus 1, and divide this value by I, which is our rate of interest, again 0.05. And because we are calculating for the annuity date here, so we will multiply it by 1 plus 0.05. This will be the formula. So these formulas are very simple. All you need to do is put the values in the formula, and using the calculator you can calculate the different values. Or another way can be using the compound value factor for annuity. Again, the different values will be given at 7%, 8%, 9%, which is again an easier method. So the future value of annuity can be calculated by annuity, which is the present annuity, multiplying it by the CV factor, the compound value factor. All right. So simply from the table also we can convert it. Now the other topics which are covered under this chapter are like capital gains, which we have discussed earlier also, which is any profit or gain from a transfer of capital asset, right? Again, the capital asset can be any property, movable or immovable. We have also studied about the short-term capital gains. If it is less than 36 months, a capital asset has been held for less than 36 months, and long-term capital gains are also there, all right, which is more than that. So another important formula which is given is the cost inflation index. Indexation, when we talk the cost inflation index, it is a process by which the cost of acquisition is adjusted against the inflationary rise. In the future, the prices might rise, So we take into account the inflationary pressures. So for this purpose, the central government has notified the cost inflation index, and what we can do is the benefit, it is available only to the long term capital assets, so we can compute the indexed cost, right? So the cost inflation index is given starting from the financial year, and the cost inflation index which can be used, and the formula to compute for the computation of the index cost, it is the cost of acquisition multiplied by the cost of inflation index of the year of transfer of capital asset. The cost of acquisition, whatever money you have paid, multiply it by the cost of inflation index of the year of the transfer of the capital asset, and divided by the cost inflation index of the year acquisition, right? If on the other hand we are talking about the cost of improvement, then other things remain the same. Simply the denominator changes to the cost inflation index of the year of improvement. The year of improvement, right? Then there are certain exemptions which are made, when and to what extent the exemption is there from the tax, the long term capital gain and the short term capital gain, which can also be ascertained. And that is all from this unit. These are the important formulae. Make sure that you write these formulae down and you practice a few questions, and that will be enough. We will also practice some questions in the numerical sessions. So that is all for today. You can also join the JAIIB selection batch for the May-June 2025, which is both in bilingual and English medium. Here you'll get all the papers. It is all in one course. So live classes, mock tests, complete basics to advanced level preparation. And you can also avail the benefit of Champions Sale. Using the code CHAMP, you can avail 50% off on your JAIIB subscription. To avail the course, use the code and join the course now. Start with your preparation. There's also a mega webinar live on how you can crack JIB 2025 in the very first attempt. So here you'll get the module-wise syllabus breakdown, step-by-step preparation strategy, insider strategy from the topper, the best study resources, time management, question and answer session. So register now for the webinar and make sure that you attend it on 22nd of February at 8 p.m. This is going to be very fruitful for your preparation. That is all for today. If you have any doubts, any queries, you can let me know in the comment section. You can also download the PDF from the description box. All the other details are also given. And don't forget to like the video, share it with your fellow aspirants, and don't forget to subscribe to the channel. I will see you again tomorrow with the next unit. Thank you and all the